Everyone keeps saying artificial intelligence is the new electricity, but electricity didn't require a $1 trillion burn rate up front. That's the uncomfortable truth nobody wants to admit right now. The AI economy is inflating at a dangerous velocity, and if history is any guide, velocity precedes implosion, not stability. The headlines sound triumphant, almost revolutionary if you don't squint. OpenAI announcing trillion-dollar data centers like their backyard greenhouses. Microsoft signing massive compute deals that look oddly circular. Oracle raising billions in debt just to finance AI promises. Nvidia itself pledging investments that feel like self-reinforcing PR loops. You've probably heard the phrase circular economy. Usually it describes recycling aluminum cans, not venture money. But right now, AI giants are tossing the same dollar around. Nvidia funds OpenAI, which then buys Nvidia's latest superchips. Microsoft bankrolls OpenAI, then sells it Azure Compute back. Amazon seeds Anthropic, then locks it into Amazon Web Services. It looks like innovation, but smells exactly like financial engineering. If you zoom out, the pattern becomes embarrassingly familiar. During the dot-com frenzy, telecom companies financed their own customers. Cisco loaned billions to network operators, who bought Cisco's routers. WorldCom took loans from equipment makers, then bought their gear back. It created the illusion of infinite demand, until it didn't. When sentiment flipped, unused fiber optic cable littered the country underground. 90% of that investment sat dark, waiting decades for relevance. Today's AI build-out looks hauntingly similar. We're not burying cable, but we're stacking server racks. Tens of billions of GPUs humming in half-empty warehouses. Electricity contracts being signed before actual AI adoption exists. Capital flooding into data centers faster than software adoption allows. It's the same story. Technology inevitable. Timing catastrophically misjudged. And let's pause on the word inevitable. The internet was inevitable, but pets.com wasn't. Railroads were inevitable, but dozens of lines still collapsed. Electric grids were inevitable, but investors still lost fortunes. AI will almost certainly transform industries, but not every company survives. The graveyard of bubbles is filled with correct ideas at wrong times. Here's a telling indicator from inside Fortune 500 boardrooms. Many companies bought site-wide AI licenses last year with enthusiasm. They expected instant productivity miracles and industry-defining breakthroughs. 6 months later, most employees barely touch the tools. Executives are quietly admitting adoption rates lag expectations by shocking margins. MIT research suggests 95% of companies report disappointing AI returns. So if demand isn't materializing, what's fueling these breathtaking valuations? The answer is shell games. Valuations are being propped up by money moving in circles. Promises of trillion-dollar spend are juicing stock prices instantly. Oracle stock jumps 25% on commitments OpenAI cannot realistically finance. And retail investors, watching from the sidelines, assume growth is real. But growth is being simulated, engineered, manufactured by interlocking commitments. Meanwhile, the antitrust risk is impossible to ignore. Nvidia controls roughly 90% of AI chip supply today. OpenAI handles the vast majority of consumer AI queries. Together, they're coordinating chip design and compute optimization. That's not just vertical integration, that's moat construction with concrete walls. It should raise every red flag regulators claim to care about. The problem is these arrangements create temporary shareholder euphoria. Nvidia dilutes 2% of equity to secure endless orders. In return, it locks in $100 billion of future revenue. On paper, that's accretive, sending the stock chart straight upward. But beneath the numbers lies no organic demand whatsoever. It's as if companies are selling to themselves, echo chamber style. History reminds us how these echo chambers collapse. Cisco, Nokia, and Lucent were once untouchable giants. They were the picks and shovels of the internet revolution. Yet between 1999 and 2001, Cisco's value dropped 90%. Lucent imploded. Global Crossing declared bankruptcy. WorldCom became infamous fraud. Tens of thousands lost jobs, and trillions in value evaporated. The similarities with AI are chilling. The optimism, the hype, the unshakable conviction in inevitability. But inevitability doesn't pay interest on trillion-dollar debt loads. Inevitability doesn't guarantee adoption at corporate scale. And inevitability doesn't protect against timing errors in capital allocation. Here's another uncomfortable truth about AI adoption. Generative models are converging on similar technical performance. Every benchmark shows Anthropic, OpenAI, Google, and others clustering tightly. That means the moat isn't product quality, it's compute contracts. It's whoever locks up chips, power plants, and data centers first. Which means differentiation has shifted from innovation to brute force spending. This isn't a technology arms race anymore. It's a capital war disguised as technological inevitability. And wars of capital rarely end cleanly or bloodlessly. Amazon survived its dot-com collapse because it raised debt relentlessly. Most other e-commerce darlings simply vanished, forgotten footnotes in history. The lesson: some winners may emerge, but collateral damage will be immense. Sam Altman seems to believe in a one AI to rule them all vision. An agentic layer seamlessly powering every digital and physical interaction. From turning on lights to booking flights, one AI in control. It sounds dystopian, but also strategically rational from his perspective. If the product is interchangeable, only monopoly scale guarantees survival. Hence the trillion-dollar bet, hence the astronomical infrastructure commitments. But monopoly ambitions carry existential risk. If the company stumbles financially, there's no fallback plan. There's no niche product to sustain revenue in downturns. There's only massive debt, massive burn, and fragile investor confidence. And when confidence erodes, capital markets punish with brutal efficiency. Think about AOL and Time Warner for a moment. AOL used inflated stock to acquire half of a real company. Employees at Time Warner watched their retirements dissolve overnight. The combined entity became one of history's most infamous disasters. That deal was hailed as visionary synergy until the music stopped. We're on the verge of similar deals in AI. Cheap capital will be weaponized to buy traditional cash-flowing companies, data center companies, utilities, even legacy tech firms could be swallowed whole. The cycle always escalates to mega mergers when froth peaks. Because executives know the valuations aren't supported by organic growth, so they need big and bold moves to keep the story alive. Meanwhile, the broader economy tells a different story entirely. Official metrics show GDP rising, corporate earnings climbing, markets surging, but those headline numbers mask brutal realities for everyday households. Half of consumer spending now comes from the top 10%. The middle class is struggling with inflation and stagnant wage growth. Cheap food staples like canned tuna and macaroni are spiking in sales. Google searches for mortgage help have surpassed Great Recession levels. Even pet ownership, America's sacred pastime, reflects economic stress. Shelter surrenders are surging nationwide, especially in major cities. Families can't afford veterinary bills or rising food costs for dogs. Animal care centers in New York have stopped taking new animals. When people can't afford to keep pets, that's a screaming indicator. The stock market may glow green, but the real economy isn't glowing. And here lies the brutal irony. AI hype is inflating valuations, but AI isn't saving households. Corporations hoped AI adoption would drive measurable productivity improvements. Instead, adoption lags, cost savings are minimal, and enthusiasm is fading. Employees experiment with chatbots, but few workflows have fundamentally transformed. Yet Wall Street is pricing in trillions of future AI profits. This divergence creates fragility, not strength. Markets propped up by selective narratives eventually face harsh corrections, and correction, when it comes, will not be evenly distributed. Retail investors chasing Nvidia at peak hype will get crushed hardest. Tech workers betting stock options will suddenly face layoffs and implosions. Even pension funds heavily invested in AI winners may suffer catastrophic drawdowns. Some optimists argue recessions are just cycles, nothing new. Jamie Dimon himself called them natural resets every 7 years. But resets don't always stop at balance sheet adjustments. Resets destroy companies, erase savings, and destabilize entire communities. And when destabilization hits young, angry populations, unrest follows. History is crystal clear on this pattern. Every major revolution starts with disaffected, underemployed young men. They are more risk-tolerant, more aggressive, more easily mobilized. And right now, surveys show 9 out of 10 young people feel cheated. They don't believe the system works for them anymore. Combine that with economic shocks, and you get combustible political instability. That's why the stakes here extend far beyond finance. If the AI bubble inflates, bursts, and destroys wealth quickly, the social fallout could be as destabilizing as the financial one. We're not just talking about failed companies, but weakened democracies. Geopolitical adversaries exploit moments when America looks distracted and divided. The hangover after a $1 trillion AI binge could be historic. And here's the kicker. The hangover is already brewing. Consumer demand isn't keeping up. Corporate adoption isn't delivering returns. Valuations are detached from reality. Circular deals are fueling stock pumps without real growth. And regulators are asleep at the wheel of antitrust enforcement. We've seen this movie before, and it rarely ends differently. The only question now is which companies become Amazon and which become Pets.com. And more importantly, how many ordinary people get trampled in between. Investors will seek safety when narratives finally lose their shine. Early-stage funds will freeze allocations to anything that smells froth. Boardrooms will suddenly prefer profitability over vaporous growth narratives. Workers will feel the squeeze as layoffs ripple through startups. Venture valuations will reprice rapidly across late-stage private rounds. Pension funds will face uncomfortable losses on concentrated tech bets. Retail holders of meme stocks will face brutal downside pressure. Banks that financed infrastructure builds will reassess credit exposure quickly. Municipalities hosting hyperscale data centers may confront unpaid tax expectations. Power suppliers will renegotiate long-term contracts after demand estimates collapse. Cities will debate whether tax incentives created unsustainable dependence. Regulators will awaken slowly, then move decisively on antitrust concerns. Antitrust suits could target coordinated behavior among chip and model providers.
Workers will feel the squeeze as layoffs ripple through startups. Venture valuations will reprice rapidly across late-stage private rounds. Pension funds will face uncomfortable losses on concentrated tech bets. Retail holders of meme stocks will face brutal downside pressure. Banks that financed infrastructure builds will reassess credit exposure quickly. Municipalities hosting hyperscale data centers may confront unpaid tax expectations. Power suppliers will renegotiate long-term contracts after demand estimates collapse. Cities will debate whether tax incentives created unsustainable dependence. Regulators will awaken slowly, then move decisively on antitrust concerns. Antitrust suits could target coordinated behavior among chip and model providers.
Courts take months to adjudicate complex vertical integration allegations. Meanwhile, competitors will pivot toward more modest, serviceable business models. Open source foundations will gain traction as companies seek vendor neutrality. Smaller cloud providers will emphasize specialization rather than brute force scale. Companies with cash flow will become attractive acquisition targets very quickly. Private equity firms will circle like vultures over weakened tech assets. Strategic buyers will prefer recurring revenue and predictable cash generation. Corporate buyers will weaponize cheap stock to purchase stable cash flows. Legacy firms will bundle AI features to protect existing revenue streams. Employees will demand clearer productivity metrics tied to AI usage. HR departments will build training pipelines to accelerate meaningful adoption. AI tooling vendors will pivot from hype to measurable ROI claims. Benchmarks will shift from raw parameter counts to latency and reliability. Investors will start rewarding efficient, well-instrumented deployment architectures. Infrastructure costs will become a focal point of investor diligence. Energy efficiency will matter more than raw peak flops claims. Data center siting will consider grid resilience and local regulatory stability. Power purchase agreements will be scrutinized for long-term viability. Contract terms promising decades of consumption will be renegotiated or canceled. That renegotiation process could leave many facilities half-finished, idle. Idle racks represent capital frozen and future returns turned hypothetical. Municipal bonds tied to data center property taxes could face downgrades. Credit spreads for companies with heavy data center exposure will widen. Lenders will demand covenants tied to utilization and revenue metrics. This will increase financing costs, compounding stress on growth budgets. Growth at all costs narratives will give way to survival and steady margins. Boards will replace charismatic founders with CFOs experienced in turnarounds. Founders who sold a vision will be judged by execution now. Public sentiment will sour when massive layoffs follow headline-grade IPOs. Narratives that once excited retail investors will instead trigger regret. Media cycles will pivot from praise to probing, then relentless scrutiny. Academic critiques will quantify overhype and publish stark adoption studies. Policy debates will shift toward limiting concentration in critical technologies. Congress and parliaments will draft bills targeting compute monopolies. Antitrust authorities will consider structural remedies and tougher merger reviews. International coordination will emerge as countries fear single-provider dependencies. Nations will promote localized OpenAI stacks for critical infrastructure resilience. Sovereign cloud strategies will gain funding and political momentum globally. A cottage industry of audit firms will emerge around AI deployments. These auditors will specialize in usage, bias, cost, and safety audits. Compliance certifications will affect procurement decisions across healthcare and finance. Hospitals will require audited models before integrating AI into care pathways. Banks will require explainability guarantees before automating lending decisions. Regulated industries will push for robust, interpretable, and well-documented systems. Startups ignoring these demands will find sales cycles lengthening dramatically. Sales teams will be forced to produce empirical pilot results. Proof of concept projects will be measured by throughput, accuracy, and cost savings. Vendors will package observability tools to prove quantifiable deployment impacts. That will create a secondary market for monitoring and accountability services. Some entrepreneurs will pivot to hybrid architectures optimizing edge and cloud. Edge compute will regain favor where latency and privacy matter most. On-prem solutions will reappear in industries prioritizing sovereignty and reliability. Hybrid models will balance cost with specialized mission-critical inference workloads. Open weights and smaller models will proliferate for localizable applications. Communities will embrace reproducible models preventing single-vendor lock-in risks. Academic labs will publish more replication studies to validate commercial claims. Peer-reviewed validation will become a currency in procurement and trust building. Conferences will be less about hype and more about demonstrated deployments. Investors will reward teams showing disciplined unit economics and repeatable sales. Seed rounds will shrink, while diligence processes lengthen and deepen. Founders will need to show early monetization and defensible customer contracts. Talent flows will favor engineers with production-grade ops and cost expertise. Salaries may stabilize as startups compete for narrower, more practical skill sets. Large tech companies will hoard experienced ops teams as competitive advantage. Governments will invest in workforce retraining programs for displaced workers. Policymakers will scramble to cushion communities affected by tech contraction. Universal basic income pilots might resurface as political discussions intensify. Social friction could increase in regions dependent on a single tech employer. Local leaders will lobby for diversified economic development urgently. Education systems will emphasize critical thinking over idiosyncratic technical skills. Civic debates will focus on rebuilding trust in institutions and markets. Meanwhile, some startups will thrive in the aftermath, lean and focused. They will offer narrowly scoped tools solving real operational headaches. These companies will grow profitably, often without headline-grabbing fundraising rounds. They will become the backbone of a more sober, sustainable AI sector. Investors who preserved capital will find attractive entry points during the down cycle. Long-term allocators will selectively buy quality companies at meaningful discounts. A reset can clear valuations and reveal actual market leaders. But the human cost will still be heavy and immediate. Unemployment spikes will ripple through families and local communities quickly. Mental health burdens will increase among tech workers facing sudden change. Policy responses must be compassionate, timely, and evidence-driven to mitigate fallout. Corporate responsibility demands redeployment programs and honest communication with employees. If leaders act prudently, recovery can be faster and less destructive. If they double down on old playbooks, consequences will be harsher, slower. So what should builders do right now to survive and thrive? First, instrument everything with measurable, continuous metrics tied to outcomes. Second, prioritize unit economics before chasing top-line growth at any cost. Third, build modular products that can integrate with diverse legacy systems. Fourth, favor customers willing to pay for demonstrable operational improvements. Fifth, design for energy-efficient inference and optimize cost per inference. Sixth, keep burn rates conservative to preserve optionality during turmoil. Seventh, cultivate diversified revenue streams across geographies and industry verticals. Eighth, document safety, bias mitigation, and data governance processes thoroughly. Ninth, invest in human-centered change management for successful AI adoption. 10th, remember that resilience beats short-lived market euphoria every time. The finale here isn't just doom or inevitable collapse. It's a complex transition asking for smarter capital, wiser leadership decisions. We will get better regulation, stronger competition, and more sober investors. We will also see painful corrections, job losses, and ruined reputations. The balance between these outcomes depends on choices made today.
The balance between these outcomes depends on choices made today. If we prioritize transparency, durability, and public interest, recovery can follow. If we favor circular deals, secrecy, and unchecked concentration, pain multiplies. Either way, AI's transformative potential remains real and historically significant. But transformative technologies require measured stewardship, not just vocal evangelism. So build conservatively, measure relentlessly, and align incentives with long-term value. That's how we turn speculative frenzy into durable, inclusive progress for everyone.